We're back. Time for Ask Annex. Matt Morzy in the studio, Director of Research, CFP. Hey, Matt.
Hey, Danny.
Fred Coleman, Wealth Manager, CFP. Welcome back.
Thanks, Danny.
Here we go. Question 1. How does the Annex investment team evaluate risks and rewards associated with investing in emerging markets, considering factors like political instability, currency fluctuations, or do you avoid those markets because of unpredictability?
Yeah, that's a really good question, and one that we actually get a lot, especially when you think of who's with considered emerging markets, and China being the largest one there. Even though they're, frankly, the second or third largest economy in the entire world, they're still considered emerging. So we definitely get that question a lot. And what I would say is that any part of a balanced global portfolio, you are going to want emerging market exposure in there. Yes, there's heightened risk. The volatility there is going to be a lot higher than in potentially in other parts of the world. But with higher risk, also the potential for higher rewards. And you have created a level of diversification by having that in there as well, too, so that if there's a time period where the U.S. is not performing, there's a high likelihood that emerging markets might be. You think back to the 2000s when the S&P was essentially flat over that decade, emerging markets was actually up quite a bit, and that was really the best performing stock asset class then. In terms of how to invest in that area, we largely like to use actively managed funds within that area. We like to use portfolio managers who have boots on the ground, that visit those countries, that have a really, really in-depth knowledge of what country are they investing in, what's the political risk there. Is it something like China that has state-owned enterprises as a portion of what they do, or is there more economic freedoms that would closer align to who we are? And so they balance those risks along with the companies themselves. They look at the data that's coming in and how reliable is it from each one of those countries, and they try to essentially outperform their benchmarks by doing that. So we really want to rely on that expertise in the vast majority of situations to do that. We do have some indexing in that area as well, too, to gain broad diversification at a lower cost, or some hybrid strategies like that. But ultimately, you really want somebody who knows that area.
Yeah, and I think one of the most important things, and the thing you hit on, Matt, that I appreciate about our investment team is whenever I'm speaking with a client and they ask, why do we own this fund? There's always a specific reason, not just because it's an emerging market, but there's a specific reason that we bought that fund, and there's a specific reason for it to be in your portfolio.
Next up, can you briefly explain how a custodial IRA works? Can I contribute it for my grandson when he's working this summer, or does it have to be his parents?
So as a grandparent, you can contribute to a custodial IRA for a minor if they have earned income. So it does not have to be the parents, but they have to have some form of earned income. That could be, from babysitting, caddying, whatever you want to do. I know I used to shovel snow as a kid. That would have been earned income. It can't be allowances. It also can't be a situation where, maybe you own a family business and, you have your 5-year-old working as an accountant. That doesn't, work out, right? I have seen those situations. So the adult, you're going to be the custodian for the funds until the minor reaches the age very similar to a non-custodial Roth. It'll just turn into a regular Roth IRA or regular traditional IRA for them, and it's going to be there for retirement. So it's going to be the same rules as a regular traditional Roth IRA. And I know we went through this a few weeks ago, but if they don't touch that until retirement, Matt, I know you broke down those numbers. I mean, it can grow exponentially, especially that compound interest if you're starting off at a real young age.
Yeah, I agree. There's a lot of power there, and that was a great segment that you and I had on that, because I think from a younger person perspective, that's a really powerful tool for them in order to maximize that wealth long term.
I'm just picturing the audit. Mr. Coleman, can you explain what a vice president of diapers is? Right. Fred Coleman is a wealth manager, CFP at Annex Wealth Management. Matt Morzy, Director of Research, also a CFP. Thanks.
Thank you.